Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing. Today is Monday, December 2nd, 2024. It's Monday, so it's time for Macro Daily Reminder Monday. I review the daily reminders only on Mondays for time's sake. And although I only bring them up on Mondays, I think it's very important for any active or serious investor to have these items in the back of their mind on a daily basis. This week I added some items, in particular the break-even rate and junk bond credit spreads. Those are things that I'm keeping a close eye on that may change in the near future. But I bring them up so often, I figured I'd just add them to the daily reminder. So let's go through them one at a time. The 2-year, 10-year Treasury yields were inverted for over 2 years, with bull steepening reversion occurring in September 6, 2024. For yields to be inverted for more than 2 years, that's very frightening. Typically, when you have inversion, it doesn't last for that long. And if it does, you have things that occur like the Great Depression. This daily reminder alone should make investors very cautious in the current environment, since typically the bad stuff really happens when we revert, which just happened only, it's about 3 months ago now, meaning we're very likely getting closer and closer to the beginning of a probably a very bad recession. Next item on the agenda, the 10-year break-even inflation rate has actually been in the range of 2% to 2.6% for over 2 years now. While some markets and some vocal investors discuss inflation being problematic in the United States and perhaps continuing to be problematic moving into the future, the 10-year break-even inflation rate is one that prices this. People are betting their money on what the inflation will be directly in this market. It compares the yield of what you can get on a regular 10-year Treasury note and a Treasury inflation-protected security. We've been in a range peaking around 2.6% and bottoming around 2% very recently, and you can see overall trending lower and very recently breaking out of sort of a consolidation to the downside, suggesting the fear of inflation may be overdone. Before we move on to the next one, I wanted to also mention the 2-year, 10-year Treasury yields. Today specifically dropped back down to 0.02%. We're still reverted, and I'll give an update if we do invert again. But just wanted to mention that. As it stands, we are still in a reverted state, which means we're pretty close to this recession that's probably coming if it's not here already. Next item is the SOM rule, which was triggered in July of 2024. Every time this has been triggered in the past, it signaled that the United States was in a recession. The way this gets triggered is if unemployment rises at an unsustainable rate. As it stands, we are still at a relatively low unemployment rate of 4.1%, though this Friday we get another employment report, so that number will likely change, and in my opinion, likely to the upside, but we'll see about that. Next daily reminder, the S&P 500 is extremely expensive right now because it has a PE ratio of 31 and a CAPE ratio of 38. Looking at a 150-year history of the S&P 500 PE ratio, we can see it is typical for the cost of $1 of return to go as low as below $6. So you pay $6 for stock and it earns $1 for only $6. And right now it's at 31. And you've seen these other spikes that occasionally go higher. This has to do a lot with earnings contraction. When companies can't earn much and they have to all the money they are earning, they have to pay on their interest payments, and so the earnings really shrink. That can also make this spike up, but we don't have that. We don't have earnings contraction. We have earnings that are basically flat, while the price of the S&P 500 is just going up an enormous amount. Paying $31 for $1 of return is very expensive. And then the CAPE ratio, also known as the Shiller PE ratio, is the price earnings ratio based on average inflation adjusted returnings from the past 10 years. This has a history of showing us when stocks are clearly overvalued. For example, in 1929, if you bought stocks in 1929, you would have not gotten your money back for over 30 years. And with inflation occurring, you wouldn't be very happy with your investment until past 30 years. Imagine waiting that long. And this was at a Cape-Shiller ratio of 31.5. We fast forward to the dot-com bubble where things got out of hand at 44 and the inevitable collapse happened. And today we're still sitting at a historically high rate at 38.5. I guess we can call that 39 now. 39 as the S&P 500 today broke to new highs. Again, this is all in the context that there are not major earnings contractions, suggesting that, these numbers aren't this high because things have gotten bad, but things are supposedly so good. It's kind of scary valuation in my book. And the other part of this is that these valuations might make a little bit of sense if rates were pegged near zero, because it allows, where do you put your money? If you put it in bonds and you get, less than 1% return on buying a bond, then it makes sense for the return expected on stocks to be also lower, making a PE ratio, a very high PE ratio, make a little more sense. That would make sense, except for the fact that Treasury yields right now across the curve are basically above 4% on the long and short end of the curve. This tells me there's a discrepancy between the value of stocks and the value of bonds right now, and I favor bonds greatly. But not all bonds are the same. Junk bond credit spreads are also at historic tightness. Going to the Fred website that shows the high yield index option adjusted spread between high yield bonds, which are non-investment grade junk bonds, and treasury bonds. When this spread goes up, it means that borrowers that have riskier debt have to pay a lot higher cost to borrow money than the treasury, which is guaranteed. In the Great Financial Crisis, this peaked out around this is 20% higher than the rate you could get on treasuries. Now, very notably, we very, very rarely get below 3% difference. You can see in the 90s, 2.59, briefly in 2005, 2.83, very notably in May of 2007, 2.46. While money was pouring into junk bonds thinking there's no risk at all, the development of what happened after that could not make them seem more wrong, putting junk bonds at a massive discount very soon after, making junk bonds actually a very attractive place to invest in November of 2008. Benjamin Graham, had he been alive in this period, would be gobbling up these bonds like there's no tomorrow because of the amount of safety and return assumed in such a steep discount in junk bonds. Now, we see in 2014 a absolute low of 3.53% difference. In 2021, around 3. Today, as of today, you can see today's number, 2.74%. This is very rare and strange for junk bond yield spreads to be this tight. There's zero fear. This suggests there may be a lot of complacency going on in the valuations of things in markets right now. And I'm not even going to bring up crypto, but you can imagine that I believe that that adds to my case that people think there's no fear. There's no fear. Everything's just going to go to the moon, go up forever, just like in 1929, where everyone should be rich, they said in a woman's magazine. Best time to buy stocks ever, 1929. Where are we in the cycle? Rate cuts began September 18th of 2024 with not just a 25 basis point cut, but with a strong 50 basis point cut, suggesting the Fed is fearful, or at the very least showing the market, yes, we will save the market. We will dig everybody out, if we see a little bit of weakness. And then in November, we got a 25 basis point cut. And as it stands for the December meeting, it's been hovering around 50-50, 60-40, whether we're going to get a cut or not. And so we'll see what happens with that. And while we are in a cutting cycle, I think it's extremely important to realize that the 3-month, 10-year treasuries are still inverted, meaning you can still get a higher rate of return for lending your money for 3 months than you can for 10 years, only because the Fed funds rate is expected to be still strangling the economy still longer. The Fed is still restrictive in this environment. I just recently, yesterday, actually saw someone talking about how the Fed is being too dovish here, and I'm just laughing. By what metric? It's above the inflation rate. It has a real rate of return above inflation. This is not a dovish stance. This is very, very restrictive. It's the only way to see it. Despite the Fed saying further weakness in the labor market is unwelcome, the Fed is still strangling the economy actively. With all the daily reminders in mind, the crystal ball readings remain. And actually, I added a little bit to this segment, and we'll get there momentarily. But the first reading is that the S&P 500 is currently priced like a Ponzi scheme, relying only on other people to pay a higher price tomorrow than what people paid today. This is not based on any kind of safe valuation, but quite the opposite at these valuations. The crystal ball reading remains based on all of the daily reminders that there is a bear market imminent. It could take longer than I personally expect to play out, but this is what the crystal ball says. We have the Fed also won't cut fast enough to save the economy. Even if they try to cut, slam rates to zero, I think it's not going to matter. And it's because our fiscal deficits have gotten so high that monetary policy has become very, very much less effective. Just like when they hiked and couldn't get inflation under control, now we're cutting and it's going to do the same thing. It's the other side of the same coin. Last crystal ball reading includes Robschild's portfolio, only because I'm sick of bringing this up on a daily basis. I'm just going to bring it up once a week and just give updates on the daily shows. I'm hoping to get the rest of the daily shows shorter and more based on Monday's show. Very importantly, this is not any kind of investment advice. Anything that you decide to do with your investments is completely up to you, and it's completely your responsibility for what you decide to do and what you decide not to do. But the Robschild portfolio currently, basically, roughly sits around this current allocation of being around 56% long duration treasury bonds in the funds of I don't actually have TLT. I use ZROZ and TMF. The more popular one is TLT. I have 10% in Brazil in the funds EWZ and EWZS, and actually a little bit in the leverage fund BRZU. While American equities are at historically expensive prices, Brazilian equities look very cheap, and although there's political risk, Benjamin Graham says that, at the end of the day, politics don't really run the world. It's business, and if businesses are super undervalued, it should be seen as a good place to be. I'll also mention that, if there's a fear of currency risk. When you own the company, you don't own the currency. You own the stuff. You own the stuff they produce, and they produce a lot of stuff. They send a lot of stuff, especially to China. A lot of food, a lot of everything. Very rich natural resources country, and the fund EWZ itself pays an enormous dividend, and so it's just a matter of time, in my opinion, for this market to wake up. That's why I'm invested in it. Also, China, I believe, is still massively undervalued. I had 10%, it grew to 13% recently. K-Web is my favorite place if you want to get extra leverage. I have also some in C-Web. Not many people probably know about it, but if it plays out to your favor, C-Web's the place to be, since you get triple the return that you would get in a regular Chinese ETF. And I have 5% of my portfolio in Nissan stock, and this, NSA and Y. This is because this company appears to me to be in great financial shape. They have plenty of money to not only cover all of their liabilities, but even if they were to sell everything they have at 50% discount, the stockholders would still, at the current price, make a lot of money. I think this is a perfect Ben Graham stock. I'd be surprised to find out if Michael Burry doesn't somehow own some of this himself, him being a value investor. I'm also 5% actually short semiconductors with the fund SOXS based on the overvaluation of the entire industry. There is an enormous amount of speculative value priced into this industry, an industry that essentially produces a commodity, and I believe will be trading eventually at a PE ratio of under 10, maybe as low as 5, like what happened to the car industry. Add to this unbelievable chart patterns developing with large, powerful red candles showing a lot of bearish strength, both on both shoulders of this massive head and shoulders top, and a double one, a white whale at the very, very top. Extremely bearish looking, because of the fact that I believe that a bear market is pretty much imminent, coming very soon. I also have 2% of my portfolio sitting in puts, long dated puts. They're called leaps on junk bonds on the fund HYG. I believe that there's two ways that this plays out, both to my favor. If the economy is hot, everything's great, guess what? Yields rise, the value of HYG goes down, putting further pressure on credit spreads to widen, sending it further down. Now, let's say the economy is falling apart, yields are going down. Well, when the economy is falling apart, credit spreads widen, also sending HYG to the downside. All paths, to the way that I see it, lead to HYG going down here, which is why I enjoy having a little speculative put position on junk bonds. Moving on to the daily part of the show. Notably today on Monday, because of the holiday, sometimes people call it a hangover day, where the professionals haven't fully woken up yet. Apparently we had pretty low volume on the day, and so you need to take what happens in markets with a pretty decent grain of salt. When see what the real action probably will start tomorrow, I imagine, on Tuesday. Also, Tuesday, we have the job openings report at 10 a.m. This could be something that really rocks markets, especially if it drops significantly, which is definitely a possibility at this point. Also, the Friday, the unemployment/employment report comes out. This was the report that triggered the SOM rule back in July, and from the way I see it, it's just a matter of time before this spikes higher, but we'll see what happens. I kind of wanted to include this in the daily reminders, the unemployment rate from the Fred website. As you can, all the gray bars that you see here are recessions. You see the 1974, 80, 82, 90, you have the 2000.com, and you have Great Financial Crisis. You can see before each one of these, we have it curling up and then spiking up, curling up, 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 spiking up. And then the COVID crash came out of nowhere, but we have been just sneakily going up and up and up. This is the Somme roll. This is it. This is right here. And if I zoom in on this, we've been going up and up and up and up. You know, if this continues higher, especially if it starts steepening, that will be further evidence that we're headed, that we are indeed in some very slow bad times coming. So Friday's report is pretty big. Moving on to the charts, we have the SPX, the S&P 500, reaching to, again, all-time highs. Some people believe that based on a logarithmic chart dating back to 1929 top, connecting to the dot-com bubble top, we may be headed to an ultimate high of around 6,100. So we'll see if that plays out that way. It looks like from today's reading, it was low volume. I mean, maybe today was the ultimate top, seeing as though we're clearly broken above the past. The market's probably going to drive it up to that 6,100 mark, and maybe it'll be at the top then. That would be my best guess. While all this is occurring, oil still bouncing along on this trend line from back in 2021. Just going sneakily sideways. If this breaks to the downside, that's it for the price of everything. We'll have major disinflation, even a period of deflation if oil collapses here. And the chart looks like it's prepared to do that with the head and shoulders here, just tightening up in this wedge. I suspect we'll get there sooner than later. Next, we have DXY getting a good bounce today. Obviously no longer in this straight up bullish pattern that we had since October through the towards the end of November. Recently we broke, just something to keep a close eye on. I wanted to bring up the CME FedWatch tool today only because we have some very strange things going on looking further out, and this website regularly makes big mistakes, and so I don't know if that's what's going on here, but I find it notable that the last time I looked at this chart, we were only looking at 2 or 3 more cuts total, and now we're looking at 1, 2, 3, 4 cuts down to 3 cuts, up to 1, 2, 3, 4, 5, 6 cuts. All of a sudden, an emergency cut happening in December of 2025 being priced in as the most probable. I mean, these are so far out that it's like it's a complete gamble. I mean, these charts change on a daily basis, so it's like it's like you turn the ship like 1 degree and you end up in another continent, kind of a thing. So, but just interesting nonetheless. Next, TLT, my favorite place to be after coming out of this diamond or broadening wedge pattern to the upside. Still looking bullish to me, interestingly. Copper still bumping along, looking suspiciously similar to oil. Head and top shoulders just getting tighter and tighter and tighter here. Obviously waiting to break out. It looks like it's going to likely break to the downside, as this would be considered to be a bear flag on this resistance line of this head and shoulders. It looks pretty strongly like copper's about to break to the downside here. Last most notable chart of the day, I'm going to say, is gold. After having this large move to the downside, it's still close enough to the bottom of the candle where it still looks like a bear flag, and so it looks like gold still wants to cool off here. If you enjoy my content, thank you for watching. If you enjoy my 2 cents, support with your 2 cents, or a like, or a subscribe. Support the channel any way you please. And that's all from me and my crystal ball. Hope you enjoyed, and see you next time. Robschild.